How to invest during a recession?
Is it safe to invest during a recession?
What is recession? A recession refers to a period of declining GDP and is generally defined as a sustained decline for 2 or more consecutive quarters.
Recessions aren't just about poor economic growth. They are often accompanied by several other characteristics: widespread job losses, fewer available jobs, and more government relief. Think stimulus payments and increased unemployment
When
benefits.
market falls, the first response for many investors is to bail out in order to stop the pain of losing money. By discounting stocks in these moments, the market is actually increasing in the future returns for investors who buy in. Great companies are well positioned to continue to thrive in 10 and 20 years, so a decline in asset prices means your potential future returns are recession. When the prices are usually lower, is exactly the time to score higher
How
returns.
to invest during a recession?
Number one, cash is king during
Recession.
economic downturn. Cash is king. As companies cut back and job losses mount, it's better to be a safe and beef of cash reserves during the times of high employment.
However, selling investments to get cash in anticipation of a recession is highly risky. You might sell prematurely and get trapped in cash as market
A
runs.
better strategy is to shift into investments that are well positioned to weather a recession. Number two, real
Real
estate.
estate can be an attractive investment during a recession for few reasons. First, you may be able to buy at a cheaper price than during a strong economy. Then, when the economy picks up and customers are more flush with cash, the value of your real estate may rise.
Many successful investors did exactly this in the last few years, scoring a 30-year mortgage below 3%. As inflation rises now and in future years, they are paying back the mortgage with cheaper dollars, making real estate an attractive inflation. Number three, use dollar cost averaging.
Dollar cost averaging is an investing strategy where you can buy a fixed amount of an investment on a regular basis, regardless of the current
Recessions
price.
are a great opportunity to use a dollar cost averaging approach because you will buy shares as the price declines. You can dollar cost average with new money or simply set your dividends to automatically reinvest in the security, which would serve the same. Number four, avoid high risk assets such as options.
Other high-risk assets such as options are not suitable for recessions. Options are a bet that a stock price will finish above or below a certain price by a certain time. They are high-risk, high-reward strategy, but the uncertainty surrounding a recession make them even riskier.
Not only do you have to correctly predict or guess what will happen to a stock price in the future, with options you have to foretell when it will happen too. And if you are wrong, you could lose your whole investment or be forced to put up more money than. Number five, buy quality assets.
Investors should seek out quality across asset classes to protect a portfolio during a downturn. Low beta, high return on investments, and low leverage are hallmarks of quality
All
investment.
weather businesses that do not depend on economic growth to thrive or survive. Companies with high recurring revenues, such as subscription based sales models, are less sensitive to economic downturns. Try to avoid companies with high debt loads, as they could have trouble servicing their debt if revenues and cash flow declines. They could also have troubles refinancing debts at maturity if credit conditions and lending standards. Number six, consider actively managed funds. For fund investors, consider shifting into more actively managed funds during
Most
a recession.
actively managed funds outperform their peers by 4.5% to 6.1% per year in down markets after adjusting for risk and
Number seven,
expenses.
keep your emotions in
The
check. Importance of keeping your emotions in check during periods of volatility has often happened during recessions. Making decisions from a place of emotions can derail even the best financial
So
plan.
I would like to recommend you to deal with the
Point
following.
A, stick with your long-term plan. No matter what the economy is doing, have a long-term investment strategy or plan and stick with it. Point B, have an emergency fund.
An emergency fund can especially helpful during the economic uncertainty of a recession. Not only can it help tide you over, but it can also help you stay invested, giving your investments time to rise again. You don't want to have to touch your investment in the middle of a recession just to pay your bills.
See, stop watching the market. If volatility leaves you up at night, avoid watching values on a daily basis.
Remember, there are more good years than bad years.
Historically, there are ways more positive years in the investment markets than there are negative years. In a recession and corresponding negative market environment, it is good to remember that better investment days are probably.
Seek an advisor if trustworthy and smart. Having an unbiased party speak reason, logic, and strategy in an emotionally charged period of time can save investors from making mistakes that could dramatically affect the long-term impact on their investment outcomes.